There's a country that can print money whenever it wants, buy whatever it needs from anywhere on Earth, and never really worry about paying it back. That country controls the world's reserve currency, and for the last 80 years, that country has been the United States. This isn't a conspiracy, it's not even controversial, it's just how the system works, and most people have no idea how absurdly powerful this makes America. Here's what that power looks like in practice. When the US government needs to buy something, anything, aircraft carriers, infrastructure, pandemic relief checks, it doesn't need to have the money sitting in an account somewhere. It just creates it. The Treasury issues bonds, the Federal Reserve facilitates the process, and dollars materialize into existence. Those dollars are then accepted everywhere: Tokyo, London, Sao Paulo, Lagos, no questions asked. But when almost any other country tries to do this, their currency collapses, investors flee, inflation spirals, the economy implodes. So why does America get to play by different rules? The answer goes back to a hotel in New Hampshire, a meeting that most people have never heard of, and a decision made in the final days of World War II that quietly shaped the next century of global power. July 1944. The war in Europe is still raging, but the outcome is no longer in doubt. The Allies are going to win. And while the bombs are still falling, representatives from 44 countries gather at the Mount Washington Hotel in Bretton Woods, New Hampshire, to decide what the world's financial system will look like when the dust settles. The previous system, the gold standard, is in ruins. Countries had abandoned it one by one during the Great Depression and the war. There was no framework for trade, no anchor for currency values, no trust, just chaos. The question on the table is simple but profound. What do we use as money when we're trading between nations? What's the universal measuring stick? The British delegation, led by the famous economist John Maynard Keynes, proposes something clever: an international currency controlled by no one country, designed to keep everyone honest. He calls it the Bancor. It's a beautiful idea in theory. No single nation gets to dominate, no one can cheat. But the Americans have a different plan. And unlike Britain, which is nearly bankrupt from the war, America holds all the leverage. The US economy is roaring, its military is the strongest in the world, and critically, it holds more than half of the world's gold reserves. So the American delegation makes the pitch. Let's use the dollar. We'll back every dollar with gold, fixed at $35 per ounce, and every other currency can peg itself to the dollar. You want stability? Do you want a system that works? Fine, we'll be the anchor. Other countries don't love this. They see exactly what it means, but they also don't have much choice. France is broke. Europe is destroyed. The Soviet Union isn't invited to the party. So they agree. The Bretton Woods system was born, and just like that, the US dollar becomes the center of the global economy. For the next 25 years, the system works exactly as designed. Countries hold dollars as reserves, and if they want, they can trade those dollars back to the US for gold at the fixed rate. International trade flows smoothly, currencies stay stable, the American economy booms. But there's a problem lurking underneath, and it's growing. The United States is spending heavily. The Marshall Plan to rebuild Europe, the Korean War, the Vietnam War, social programs at home. All of this requires dollars, lots of them, and the US is printing more than it has gold to back up. By the late 1960s, other countries started to notice. France, under President Charles de Gaulle, is particularly suspicious. The French do the math and realize the US doesn't actually have enough gold to cover all the dollars circulating in the world. So they start exchanging their dollars for gold, and they do it aggressively, almost as a power move. Other countries watch and start to get nervous. If everyone tries to redeem their dollars at once, the whole system collapses. The US gold reserves are draining, and President Richard Nixon has a decision to make. August 15, 1971. Nixon goes on television and makes an announcement. The United States will no longer convert dollars to gold. Just like that, he severs the link. No warning to other countries, no negotiation. It's presented as temporary, but everyone knows it's permanent. This is called the Nixon shock, and it fundamentally changes everything. Suddenly, the dollar isn't backed by anything physical. It's not backed by gold, not backed by silver, not backed by land or oil or anything you can hold in your hand. It's backed purely by faith. Faith that the U.S. government will continue to exist, that the U.S. economy will remain strong, and that people will keep accepting dollars in exchange for real goods and services. Most currencies throughout history that tried this, that abandoned hard backing, eventually failed. They inflated into worthlessness. Governments printed too much, people lost trust, the currency died. But the dollar doesn't die. In fact, it has become more dominant than ever. Why? Because even without gold backing it, the world still needs the dollar. Oil, the most important commodity on earth, is priced in dollars. If you're in Japan and you want to buy oil from Saudi Arabia, you need dollars to do it. International contracts, shipping, commodities, all priced in dollars. The infrastructure is already built. The system is already in place. And critically, there's no alternative. Europe doesn't have a unified currency yet. The Japanese yen isn't trusted outside Asia. The Soviet ruble is a joke. So the world keeps using dollars, even though those dollars are now backed by nothing but the word of the US government. This is the birth of the fiat currency era, and it hands the United States an almost unimaginable advantage. Here's what that advantage looks like in the real world. Imagine you're a small country. Let's say you're Thailand. You want to trade with other nations, so you need dollars in reserve. To get those dollars, you have to sell something. Electronics, textiles, rice, whatever your economy produces. You trade real goods for dollars, then you hold those dollars, often in treasury bonds, as savings. Now imagine you're the United States. You want to buy electronics from Thailand. You don't need to sell anything first. You just pay in dollars. Dollars that you can create. You're buying real goods with money that costs you almost nothing to produce. This is called seigniorage, the profit a country makes from issuing currency. And when your currency is the global reserve, the seigniorage is enormous. But it gets even better for the US. Because the world needs dollars, there's constant demand for them. That demand keeps the dollar strong, which makes imports cheap for Americans. It also means the US government can borrow money at lower interest rates than anyone else. When the Treasury issues bonds, investors around the world line up to buy them because they need a safe place to park their dollars. So the US gets cheap imports, cheap borrowing costs, and the ability to run large deficits without immediate consequences. It's an extraordinary privilege. Economists have a term for this. They call it exorbitant privilege. The phrase was coined by Valéry Giscard d'Estaing, a French finance minister in the 1960s, and it was not a compliment. But privilege always comes with temptation, and the temptation for the United States has been to use this power more and more aggressively. In the 1980s and 90s, the US started to weaponize the dollar. If a country does something America doesn't like, the US can cut it off from the dollar system. It can freeze assets, block transactions, impose sanctions that cripple entire economies. This happens to Iran, to North Korea, to Russia after the invasion of Crimea. These countries suddenly find themselves unable to do international business because they can't access dollars, and almost all international business requires dollars. It's financial warfare, and it's incredibly effective. But it also makes other countries nervous. If the US can weaponize the dollar against its enemies, what's stopping it from doing the same to its rivals, or even its allies, if interests diverge? Countries start looking for alternatives. China launches the petro-yuan, trying to get oil trades settled in its own currency. Russia and China begin trading in rubles and yuan, bypassing the dollar entirely. The European Union pushes for the euro to take on a bigger role. But here's the problem with all these alternatives. None of them are actually ready to replace the dollar. China's financial markets aren't open or trustworthy enough for the US to do this. The euro is strong, but the EU is fragmented and lacks a unified fiscal policy. No other currency has the depth, liquidity, and stability that the dollar has. So the dollar remains dominant, for now. Let's talk about what keeps this system running, because it's not magic and it's not guaranteed. The dollar's power rests on three pillars: military strength, economic size, and trust. The US military ensures that global trade routes stay open, that oil keeps flowing, that the international order remains stable enough for commerce to happen. It's not a coincidence that the world's reserve currency is issued by the country with the world's most powerful navy. The US economy, despite its problems, is still the largest and most dynamic in the world. It's the place where global capital wants to be. People want to invest in American companies, hold American assets, park their money in American banks, and trust. Trust that the US won't suddenly decide to inflate away its debts, that it won't confiscate foreign assets without reason, that the rule of law will hold. But all three of these pillars are showing cracks. The national debt is now over $34 trillion. That's more than 100% of GDP, and it's growing faster than the economy. Eventually, this could spook investors. If they start to doubt that the US can manage its finances, they might demand higher interest rates on treasury bonds, which would make borrowing